Strong day so far. You're with us here on a fresh new edition of Closing Bell. I'm Prashant. With me, my colleague Reema here in the newsroom, and Nigel is, as always, joining us from the studio, the newsroom floor. Guys, hi. Good afternoon. 100+ points, so nothing to really complain about. And I think after a fair bit of flip-flop in the first 1.5 to 2 hours of trade, the direction is now set. It's higher. So we're at 17,305. And I'll get to levels in just a bit, but global cues are positive as well. I mean, it's not as if the rest of the world is down and out and the market here is rallying. US futures are up between 0.75% and 1%. European markets are up 0.5%, 0.75%. And Asia, by and large, was not bad. So in that light, I mean, things are looking quite okay. Financials, and this is a point we were talking about in the morning, that's the clear-cut trade here. Both private and PSU banks are doing very well. Earnings, of course, are tying in nicely as well. Metals started lower, they remain down as well. And mid-caps are relative underperformers. I mean, actually, the small-cap part is doing better, but mid-cap as an index is relatively underperforming. NSE advanced decline, the last I checked, was about 1:1. We'll see how that changes. Now, on the levels, Nifty needs to basically hold the 17,300 level. That's the first area of resistance. We're right on that. And the next one is 17,421. Which I think is the 50% retracement of the September fall. The market's gone there a couple of times over the last 10 days, 12 days, and it's come back once again. So the range, hopefully, will be taken out or taken out on the upside. But those are the levels broadly to watch out for. On the lower side, if you get a bit of a swing, I mean, I think the big one, of course, is the 16,950 level, which was the low point on many occasions last week and the week before. Reema, hi.
Hi, just as of now, at least so far, we've not managed to cross last Friday's intraday high, which is about 17,348. So we're inching close to it, but we've not managed to conquer that just yet. But there's been a flurry of earnings, so we've been hit hard. The earnings season is hotting up. So quickly to run you through the earnings misses and hits for the day. ACC, a big margin collapse, much lower than street expectations, but the stock is reacting positively. It's up close to about 1.5%. A lot of people on the street are calling it perhaps a kitchen sinking quarter ahead of the management change. So that stock is higher by close to about 1.5% despite the margin miss. And Nigel will be talking more about it. But Heidelberg, Tata Elxsi, a very sharp reaction on the way down to these misses. So those stocks are under pressure. Oberoi Realty and D-Mart. For D-Mart, we had a sneak peek into the top line, but we didn't have a picture on the margins. And margins for D-Mart have come in lower than expectations, which is why, despite having that little bit of that business update from the company, you can see a decline of 3% once the actual numbers have come out. And again, the management reiterating that there is rural stress, which is why the lower ticket items have been on the weaker side. Some of the earnings hits. Bank of Maharashtra, so that's reacting positively. That's up close to about 4.5%. And Just Dial, that's been a bit of a sleeper hit for the last 2 quarters or so. Slowly the numbers are recovering despite their exposure to the SME space. And finally, PVR is the one where the numbers have just come out and the stock price is still reacting after the robust performance of Q1. There is a drop-off of 30% on a quarter-on-quarter basis. But I guess that's something the street expected, right? We didn't have any big hits except Brahmastra towards the end in September when things picked up. But other than that, it was a washout, like Bollywood and Hollywood. And, this time, the contribution of regional markets, right, your South markets, etc., has risen to 44% of its overall gross revenue. And that's incredible. Yeah. So we'll get chatting with the management of PVR as well. But Nigel, what are you tracking for us?
Well, the call earlier this morning, Reema, was Prashant will recollect that the bias was towards the positive end. And, if you're going to be getting a bit of a downtick to kickstart trade, the data point suggests that maybe you'll have a bit of an update. So that was our call this morning. And it appears it's playing out in that manner itself. But you'll get a really big up move if you get past the 17,350, which is the high that we saw on Friday. So we'll have to keep an eye out on that front. Monday has been a pretty good session. Let's see how we end this session. For the time being, though, let's run our viewers through what we have lined up on the show for you. It's a good day of trade for the Indian markets. The Nifty as well as the Sensex, both of them are higher, clocking in gains of close to around 0.5% each. Financials lead the charge today, but the mid-caps, they trade more or less flattish. Metals and Realty drags in trade. The cement pack is in focus on the back of its earnings. ACC and Shree Cement, a detailed earnings fine print is what we have lined up. And Tata Elxsi, well, that's trading in the red on the back of dismal showing. Valuations as well at elevated levels. We'll get you a quick detailed check on that one. And our Alpha Manager of the Day, Rupesh Patel of Nippon India Mutual Fund, will be joining in to understand the stocks and sectors to bet on this Samvat.
Okay, so 110 point basically on the index right now. How should you position yourself in the last hour of trade? Mitesh Thakkar is with us of earningswave.com. Mitesh, good to have you with us here. So just at 17,300, is there a trade on the Nifty, or you need to wait for, either for the market to move on either side for risk reward to become a little more attractive?
Prashant, actually, I'm just waiting for it to get past 17,350. 17,348 was the high we got on Friday. So I'm just waiting to clear that. Once that happens, a long trend with the 50 point, maybe 55 point stop can be initiated. Having said that, I have two buy calls, and you were highlighting, I think Nigel was highlighting banking index, and State Bank of India has given some kind of a breakout on the intraday charts and the daily charts. Disclaimer, we have some call options positions over here, so have an interest. But I would recommend buying this one with a stop below 534 for targets of 560. And NTPC is something which I like as well. It's also forming a good setup on the short-term charts, positive one. So buy here with a stop below 165 for targets of 175.
Okay, those are some last hour strategies for you. Thank you very much, Mitesh. We'll reconnect, in some time. Let's also invite on the show now Deepak Shenoy, the founder of Capital Mind, on the show now. Deepak, open-ended question. We've had, earnings season go on for more than a week now. Which one is the standout performer for you on the way up or on the way down? Which stood out for you? And therefore, was there any trade or any stock that you got into or exited based on that?
Afternoon, Rima. I think, the results season is still open, so we're not, taking our positions yet. But the banks, both Federal and HDFC, I think have announced very decent results. Federal more than HDFC, and I think that's the standout performer till now, if you may. But we're expecting some kind of moderation from some of the retail players. We're seeing PVR. I think the numbers just came out, so I don't have a view on it yet, but it might give us an idea into retail sentiment. I also expect something decent from some of the mid-cap players who don't have too many hedges in place, especially where they're serving the US. Other than that, I think much of the results are still ahead of us. We haven't seen much in the manufacturing sector yet. We haven't seen the autos report too many results. And we have to remember that last year, this September quarter was not such a great one because it came in right after a lockdown quarter. So there will be some kind of a base effect as well. So still waiting, haven't taken a new set of positions yet.
Okay, Deepak, stay with us. We have the management of PVR joining us now. They reported numbers just 15 minutes back. Let's get speaking with the management at the back of the second quarter earnings which have come through. So we've got PVR's chairman and managing director Ajay Bijli and Nitin Sood, who's the chief financial officer, joining us right now. Great to have both of you here. Thank you very much. Ajay, I have to say that last week I was in shooting at one of your cinema halls here in Mumbai. The Mason PVR at Geo. It was a fantastic property. Now I understand that you are interacting with us from PVR's first director's cut in Haryana, in Gurgaon.
That's right. Yeah, we are in ambient small Gurgaon just now. And we concluded our board meeting here just now. So, this is also a luxury format and exciting to create new experiences for the consumers of India.
Absolutely, absolutely. Ajay, so coming to numbers, it was a kind of strange quarter, isn't it? I mean, you had this boycott Bollywood kind of thing happening. There was a paucity of, I'm assuming, sort of content which clicked with the customers. There was a fair bit of content, but not, maybe with the exception of Brahmastra, not very much clicked. But was Brahmastra really, in that sense, the Brahmastra for the industry? Did it prove to be? I'll just put it in context for us.
Yeah, sure. You see, India is a very heterogeneous market. So whatever is true is also untrue, as Amartya Sen has always said. So if you look at the behavior of the consumers in down south, the movies have done phenomenally well and is back to pre-pandemic levels. People are coming back and they're connecting with the content. And our business is all about whether consumers connect with the content or not. I don't think it's a habit that is going to go away. But it's just an aberration that this quarter, a lot of the content that came, especially during 15th August, when 2 big films got released, that didn't connect with the consumers. But then you had Vikram Vedha, which came, that has done fairly well. So Brahmastra did exceedingly well. I think it did more than what I was expecting, given the fact that there was so much noise about, again, will people come? Have they, incorrectly talking about, have they boycotted Bollywood? So I thought it won't do that well, but it ended up doing 268 crores just in India, which is huge box office. So the fact that people still want to go out and entertain themselves, they want to see something on the big screen is very much out there. It's just that, we've had a time where at least the Hindi content hasn't connected that much. But as I said, down south, people are coming back in hordes to watch movies. And that is also very good for PVR because our circuit is spread across the entire country now. At least 40% of our screens are down south now. So therefore, we hedge our risk by not depending on one kind of content only. We can play Hollywood, Bollywood, Tamil, Telugu, Kannada, Malayalam. So it basically balances itself out.
Afternoon, gentlemen. Can you talk about your screen opening plans for the full year? For the first half, you've opened 24 screens and, of course, one in Haryana, which looks fantastic, the little bit that we can have a sneak preview. But you had plans to open 110 to 125 for the full year. Considering that you still have to open, 90, 100 from here on in the matter of 6 months, are you on track for that, your guidance on screen openings for the full year? And given the switch now more towards regional languages, would that be the focus? Where would the bulk of these openings come from?
Well, we are on track, first of all, to answer your question. Of course, it gives a bit of a skew, which doesn't sound very favorable because only 25 we've opened in the first 6 months. But most of these cinemas are almost 80-90% ready now. It just got bunched up together that they will open in the second half. But they're spread all over. And it's more where the malls are coming up, where the infrastructure is, the kind of cinemas we want to build rather than any regional strategy as such. But yes, again, South is where most of our cinemas are opening up. But we have a big one in Lucknow also opening with Lulu. With Prestige Group, we've got about 3 opening up. Again, one in Bangalore, one in Kochi, one in another one in Bangalore. But it's spread all over. It's not in Mumbai. We've got one in opening up in Navi Mumbai just now. So it's more where the correct infrastructure is there, correct malls with the correct developers who are building, future-proof malls with the correct infrastructure, and where PVR should be housed. So currently, we are still going with serendipity rather than having any doing things on our own. It's wherever the infrastructure is moving, retail infrastructure is where we are moving.
Hi, Ajay and Nitin. Both of you are sounding reasonably optimistic and you'll want to give a new experience. It's coming at a cost, though. So the average ticket price as well as spends per head are moving higher. Good for your shareholders, not too good for a customer like me. Be that as it may, what's your sense? Do you expect it to trend higher from here on? Point number one. And also, I wanted to ask you all, a couple of PEs, they have been selling a lot of stock. Have they reached out to you all, because your stock has a high amount of institutional holding. Any sense, any kind of communication with them?
Yeah, I mean, I think I'll let Nitin answer. I don't want to hog the show here. Nitin,
sure.
You want to?
Yeah, I think we have 2 private equity funds, Warburg and Multiples, who've sold part of the stock during the last quarter. They've invested with the business and they've been around for 6-7 years. And as you know, in private equity domain, every private equity fund has a shelf life. So I won't read anything much into that. We were aware of the potential sale, and I think it got sold out in the market and bought by a lot of long-term institutional players. It's just moved hands. But there's nothing more than that to read into.
Nitin, since
your second question was on ticket.
Nitin,
Yeah.
Before we get to the second question, I just wanted to ask you, so they've reached out to you. Have they communicated what they want to do with the remaining part of their holding in it? As you said, they have been long-term holders. They made, fairly decent returns. And as is the case in their business, at some point of time, they want to get out. So do they want to completely get out of it?
Yeah. Yeah, at some point of time they would, but they haven't formed any view on the timing, etc. I think it's also partly connected to the life of their own individual funds. But at some point of time in the next 12 to 15 month window, they would, definitely, take a exit, given the shelf life of the investment that we've had in PVR.
Ajay, just to come back a little bit to the content, right? Because that is what is going to get customers into cinema halls. Will we start to see, a different type of content? I don't know what for, or do you think? I mean, it's just a matter of clicking. What are you seeing out there in the pipeline in terms of the kind of projects which are now coming to the table to be made? Are we starting to see a little bit of change in terms of the type of content? Is there a change there? And in what sense, if any?
You see, content, I mean, that's the difference between the Indian market and any other market, and which is the reason why I hesitate to venture out of India, because India is all about volumes and variety, both in terms of the movies that come. 2,200 movies came in 2019. That's a lot of movies. And also 1.4 billion tickets got sold. I think consumers have a disparate taste. The filmmakers have, all sorts of movies they're making. First of all, at a very basic level, it doesn't matter whether it's a big movie or a small budget movie, it has to connect with the audiences. You had smaller movies also this year. I mean, not very small, but still Kashmir Files wasn't very big. Gangubai was somewhere in the middle, but it connected with the audiences and people came. Then you had your big spectacles like Brahmastra and all that connected. Down south, all sorts of movies are coming. PS1 just has already done 250 odd crores. It just got released in on September 30th. So this quarter, we'll see the result of that. So I think the fundamental thing is it connecting with the audience or not? However, as far as experience is concerned, definitely the reason why I think you just now, or your colleague asked me this question about Maison PVR or where we're sitting just now, I think consumers definitely want to see something when they step out of their homes, and experience something that they can't experience at home. So you definitely need the screens to be bigger, sound to be better, seating comfort to be there, overall guest experience to be very good. Only then they'll say, okay, wow, that's the reason why I'm going to come out and watch movies. So I think these are the things which we are providing currently. But yes, you're right, the content has to connect, and it's very temporary. Couple of months here and there are not going to change either the filmmaker's vision to connect with the audiences, nor the appetite for the Indian consumer to go out and watch movies. I mean, we're building 150 odd screens at any given time. So we continue to remain very optimistic about the future of the business.
The problem, just to add to a point about connecting with the audience, the content connecting with audience. Now, Lal Singh Chadha bombed in the theatres, but when it released on the OTT platforms, I think on Netflix, in the first week, it's garnered some massive views. I think 6.6 million hours viewed, and the film has finished second on the global non-English movies chart. So clearly the audience was waiting to watch this movie. They've liked it, and the content has connected with them on OTT. It's just that they decided to give it a pass to the theatres. But anyway, I just wanted to make that point. But, Ajay or Nitin, could you give us some numbers?
No.
Go ahead.
I can make... Okay. No, it's fine. I'm just saying that, so many factors were at play at that time. And therefore, it didn't connect. It just goes to show that there are other factors that were at play which didn't make the people come to the movies and cinema and watch the movie. But overall, when they realized that the movie is good, the reviews were good. So this is the nature of the beast. Some movies connect, some movies don't connect. But as I said, because the quantitative aspect of the Indian market is so phenomenal that even if one movie doesn't do well, it's okay, because there are other movies which become sleeper hits and they compensate. In Hollywood, 180 movies were getting made earlier, and only 73 films are getting made this year. That worries me. So the markets which are very Hollywood dependent are the ones which are getting impacted most. But India, I mean, the volumes are so high that if one movie doesn't do well, it doesn't really matter that much.
Okay, just one more number. What was?
I think one big shift which is... Yeah, one big shift which you will notice is happening, is that a lot of films which are now going on the floor, especially all the big films, are being made in 4 to 5 languages. They are originally being dubbed in 4 to 5 languages because suddenly the South Indian filmmakers have realized that India as a territory is the whole market for them, and The Bollywood filmmakers have realized that the whole country is a market. So you will see, I think, in the next 12 months, whatever the new films release will be released on a pan-India scale, dubbed in multiple languages. And that's going to see, a big impact, positive impact on the box office collections for the entire country.
Got it. Fair point. Nitin, what was the occupancy level this quarter? The number, please, and the ad revenues as a percentage of normal levels. I think in Q1, the number you all shared was 68%. What would that similar number be, comparable number be?
Yeah, so our average occupancy during the quarter was about 24%, which is significantly down as compared to what we normally do, which is an average of 35% plus, which is reflected in the admissions that we've got during the year. Our ad revenue numbers still continue to be, at 60-62% level of where we were pre-pandemic. So that's lagging in recovery, and that's largely, linked to how the box office recovers. We've always guided that, ad revenue will recover with a lag of 1 quarter of box office recovery, because advertisers want to see proof of admissions back at cinemas. But it's trending well. Hopefully Q3 is looking quite strong. We have a lot of big films releasing this quarter, and hopefully this should be a bounce back quarter.
All right, if there's a bounce back, this is perhaps the best time for it, with the festivities and the festive season generally, and Diwali upon us as well. Gentlemen, it's a pleasure. We'll leave it there. Thank you, both of you, for joining us. Nitin and Ajay, great to chat with you as always. And from all of us here, wishing you and your teams, your families, a very happy Diwali. Thank you. All right, we'll take a very quick break here. We'll be back with our Alpha Manager of the Day as well. Rupesh Patel of Nippon India Mutual Fund is going to be with us. We also, of course, have Deepak Shenoy, who's been waiting by. Markets doing just fine, 117, 118 points in the green. Stay with us.
Welcome back. Well, let's run you through a couple of cement names, that did come out with a result just in the last 60 to 90 minutes or so. Let's start off with ACC. Well, the numbers were weak. No two ways about that. On the top line, it was more or less in line. The EBITDA number, though, came in only at around 16 crores. We were working with a number from 270 crores, and margins came in at a slim 0.5%. While they delivered a net loss this time around, we were at least expecting 100 crores of net profit. So those numbers are very, very weak. What led to these weak numbers? First, on the top line, a marginal miss. Close to around a 2% miss is what we saw in comparison to the volumes that we were working with. Point number one. Point number two, costs remained very, very elevated. The power and fuel costs, well, they spiked up big time on a year-on-year basis. The problem was, even on a sequential basis, there was no cooling off. So that's the second part. RMC business, that's a smaller part, only 10% of their revenues, but the EBIT number came in only at 1 crore, which compares to around 10 to around 12 crores odd. So a smaller part of their business did miss out. So all these factors, you put it together, and there was a miss. The reason they delivered a net loss was obviously because they delivered a weaker than expected operating profit. Not just that, you also had an exceptional item to the tune of close to around 16 crores. However, the stock is not corrected big time. Why? In the last 1 month or so, the stock corrected close to around 20% from its recent peak. If a 1-month chart comes up for you, that will tell you the picture. And the second point out there is that valuation-wise, it trades at near EV per ton of close to around $115 per ton, and also 10 times EV per EBITDA, which is a big discount in comparison to its peers. So there is some valuation comfort. Heidelberg Cement as well, they came out with the set of numbers. Revenue is down by close to around 12%. That was because sales volumes, corrected by close to around 19%. There was some part of that was offset. Realizations came in high by close to around 8%, but the EBITDA margins came in at less than 10%. That's the lowest margins we have seen in multiple years, actually. And EBITDA per ton came in less than 500 rupees per ton. Remember, in the same quarter last year, it was close to around 950 rupees per ton. The key reason was spike in coal cost, pet coke prices, as well as packaging costs. That's the reason why, in fact, we had a big miss even on the net profit number. Well, Deepak, I've run our viewers through those numbers, and clearly they were very, very disappointing. But it seems it's like a kitchen sinking quarter, right? The street was as it is expecting very big numbers, and they're optimistic about the second half of this year. Are you in that camp? If yes, what do you look to buy?
No, I'm not in that camp. Honestly, I think unless we're seeing a margin compression, which we've been expecting. So it seems to be a little bit heavier than I thought. In pretty much every of the weak results we've seen, I think margin compression has been quite honestly quite challenging. And this is because the inherent inflation that's there in the system is starting to affect the larger players now, whether it is power and fuel costs or general wage increases and so on. So I expect the rest of the year to actually be weaker. In fact, even if you look at GDP projections, the real growth is going to be a little bit weaker on a percentage basis for the December and the March quarter. So I don't expect major fireworks to happen in the next 6 months. A lot of the macro events of the West will kind of affect the liquidity here. So based on that, interest rates may continue to rise a little more than where they are right now. So there's going to be some more effect on margins, not operating, but post-interest margins. So I think we're in for a little bit of a tough time fundamentally. But let's see how commentary comes through. Right now, I'm still talking from the outside.
Okay, Deepak, we are out of time. Thank you very much for joining in. So he's expecting a tough time for cement going ahead. The banks, the earnings that have come through, Federal Bank and HDFC Bank, look pretty solid. Rupesh Patel, the Senior Fund Manager, Equity Investments at Nippon India Mutual Fund, is now with us on the show now. Rupesh, thank you for patiently waiting by. Thoughts on the markets now and the kind of positioning that you would recommend. What are the sectors that you're bullish on right now? What are the sectors that you have avoided, and any tactical shifts that you've made in your mutual fund?
Sure. Thank you so much for having me on the show. So in terms of sectoral positioning, we have significant overweight on financials in our portfolio. And within that, banks and large banks, they are the significant overweights. And the thought over here is that if we look at large banks, then in current environment when interest rates are going up, they have strong CASA franchisee, which helps them in terms of their cost of funding. If we look at credit costs, then the NPAs of last cycle, they are very well recognized and provided for. And broad economic momentum in India seems pretty good, and we do not feel that in the near term there is any risk as far as credit costs are concerned. They are well capitalized, ROA are healthy. In fact, we are seeing that some of the provisions which these banks had taken in last few quarters, they are getting reversed as credit quality turns out to be better than what was expected. So we believe net, I think financials and within that large banks are very strongly positioned. Credit growth, it is becoming more broad-based. Margins are likely to remain stable or marginally expand. And hence, we have overweight stance as far as financials and banks are concerned. In terms of avoid, we have generally, tended to be underweight on sectors, companies which have global orientation as far as their growth is concerned. So one sector where we are maintaining, we had and we still continue to have underweight position is information technology. These companies did very well in post-COVID world because it was expected that their growth profile will significantly change in the post-COVID world. And there were obvious margin tailwinds as well. As we move ahead, as there are concerns on slowdown or recession in developed world, IT budgets, there seem to be some uncertainty around that. So considering the risks involved, this is one sector, and generally companies which have global orientation, we have underweight stance in our portfolios.
Okay, underweight IT, overweight financials. By the way, the market breadth has decisively swung. We are 1,200 stocks plus lower. It's not a huge gap, but losers outnumber gainers by about 300 odd names now. It was exactly 1:1 when we started the program at 2:30. Rupesh, how much more broadly as you think about IT services before they get into what you would describe as an attractive, viable kind of zone?
Yeah, sure. I think if we just go back maybe 2 quarters or so, the valuations of IT companies, they were reflecting expectations of meaningful acceleration in their earnings growth. And there was some kind of extrapolation in that growth numbers which were reported by companies. We have seen valuation correction happening there. And in some cases, even earnings are getting revised downwards. We believe there is still some way to go as far as earnings revision is concerned. I think and coming quarter, in any case, it is expected to be relatively weaker quarter. But a lot depends on how commentary, comes from IT companies, particularly on IT budgets. going ahead. That's something which we'll get an idea early next year only. So I think there is still some way to go, at least in terms of earnings expectations getting moderated.
Rupesh, what if these stocks correct but a good 10-15% from here, which it's not unlikely to happen. It could possibly happen if the globe goes into a bit of a tizzy. Would you then change your underweight stance? That's on IT, and I believe you also like or the auto space. What do you like out there?
So we would selectively look at, adding, as the valuation expectation, as the valuation or earnings expectations they moderate. Definitely this sector, will have good exposure in our portfolios, because all said and done, these companies, they are good quality companies. They generate healthy cash flows, and if you look at the return ratios, they are capital users. They are efficient users of capital. So I think, they would find exposure in our portfolios. So at certain correction at some point in time, obviously they would start looking attractive, and we would look at adding them to our portfolio. As far as auto sector is concerned, we have some exposure, combination of OE as well as some select auto ancillaries over there. Within that, more from a near-term perspective, more positive on passenger vehicle segment. And we believe that in the near term, there are some tailwinds on account of commodity prices correcting over there. So yeah, on selective basis, PV is one segment where we have some exposure.
Broad consensus is that because there is so much global uncertainty, there is relative comfort on the domestic demand. And in that, a lot of people are also bullish on cement. But the two numbers that we've got today, ACC and Heidelberg, have missed street expectation, and margin pressures are real. The kind of fuel inflation we've seen, the increase in cost of production, etc. In that context, what would your thoughts be on cement? And is the street over expecting, being too bullish on cement? Could things get worse for them on the margin front?
I think current quarter was expected to be a weak quarter on account of inflation in fuel prices, which we have seen. But going ahead, we have seen petcoke prices correcting from their highs. Though they still continue to be higher than what they were before the crisis started. But going ahead, we expect that the margin pressure which we are seeing in this quarter should start reducing as far as demand is concerned, with infrastructure investments picking up, real estate sector expected to do well in terms of demand. The demand side should also start looking up. So as far as demand is concerned, as far as margins are concerned, I think outlook is better over there. But as far as stock prices performance are concerned, I think one factor which we'll have to watch out for is what happens to realization. So that's something which we need to watch out for, as far as, which would be an important factor to watch out for as far as performance for cement stocks is concerned.
Okay, all right, Rupesh, it's good hearing your thoughts. Thanks so much for stopping by and filling us in with a whole host of, sectors that we did discuss. Wishing you a happy Diwali in advance, and appreciate your time here on CNBC-TV18. Well, it's time to slip into a short break. When you come back, Nimesh will be joining in. He'll tell us what's going on in dealing rooms. We'll also get our technical experts back with us. They'll tell us what they made. Welcome back. Well, markets holding comfortably above that 17,300 odd mark. But, Prashant and Rima was getting a little lonely out of the studio. So Nimesh is joining in. He's coming to give us some company. Nimesh, what's the sense in terms of dealing rooms? The mid-cap index is starkly underperforming, but you've hit a century on the Nifty.
So, Nigel, as you rightly pointed out, the market are at days high, largely led by financials, but that's not the case as far as the flows are concerned. In fact, the flows are contrary to what the market screen looks like today. So I'm told overall there is negative flows at the FI desk, while the Nifty bank is at 1.5%. Both PSUs and private banks are buzzing in trade. Even in the banking stocks, the overall feedback is there is a bit of profit booking the private bank stocks today. So it looks like after HDFC Bank and Federal Bank reporting good numbers, there is a bit of rub up in the PSU bank stocks. But on the contrary to flows, there is a bit of profit booking the financial names as well. So that's the overall feedback. Even in the PSUs, not the PSU banks, but overall in the PSU basket, there is a bit of selling pressure today. So as I said, contrary to the screen, the screen is looking very good. Nifty Bank is looking good. but there is selling pressure is what I understand from the larger FIs. From a technical point of view, now we are back to the higher end of the range. We've been talking this for a while now, 16,950 to 17,300, 17,400. We're pretty much close to that 17,400, the crucial resistance level, so to speak. So I guess that's the level to watch now. Above 17,450, maybe we'll see a further short squeeze. But today, while the screen is looking good, there is a bit of profit booking, whether it's in financials or in the PSOs.
Well, that's
the overall
interesting, Nimish, because one would have thought that maybe there is it's backed by flows, but you're saying that that's not the case.
It looks like it's more of short covering rally rather than a genuine buying from the larger FI.
Okay, let's get to the juicy part. What about individual stocks? What are you picking up?
Nigel, this is very tricky now because of the earnings season. It's going to be very challenging for me as well to find out, juicy, so to call charters and all. But anyways, the first stock is Apollo Tyres. That stock is buzzing in trade today. After a long time, it's come into my charter list. It's backed by good flows as well. So the delivery volumes, I understand, are going to be quite high in Apollo Tyres today. So it looks like some FIs are backing this particular stock. That's the first one. The second stock is Nykaa. That stock is down in a good market. That stock is on 3%, largely on back of sell flows at a leading FI desk. Remember, for all these new listings, come November, you're going to see a large, blocks coming in because of the lock-in, getting over for many of the stocks. So come November, as even Prashant had pointed out earlier, $10 billion of flows can come in terms of lock-in getting open for all these IPOs. So it looks like there is a bit of pressure now in Nykaa, largely from a selling pressure point of view. And the third stock is Pidilite. You highlighted Pidilite in the morning as well. Again, it's buzzing in trade, up 2%, largely on back of good flows. Even IFL put out a note today morning, and according to that note, even they are suggesting that Pidilite is the most possible candidate to replace HDFC in the Nifty bank, as and when HDFC moves out of the Nifty. So that's the reason why Pidilite is buzzing in trade, purely on back of anticipation of getting added. So the passive funds will start buying in, so there is a bit of preempt move as well in Pidilite today.
Okay, all right, Nimesh, thanks so much for stopping by and in fact giving us all those views. Well, for the time being though, let's get in Mitesh Thakkar yet again. Mitesh, what are you making of today's action? We're still holding with some good gains. If you could give us a sense on the Nifty as well as your individual calls.
Yeah. Good afternoon, Nigel. I think, as I said, waiting for Friday's highs to be taken out before going long aggressively on the index. But I think the way the setup is, I think, we're trading with more long buys. I'd given a buy on SBI earlier. Bank of Baroda is something which I would recommend as, a BTST kind of a trade. Also, now trading near the day's high, I would recommend a BTST here with a stop below 134.5 for targets of 138, 139 on for tomorrow. And the other one which I like is Bajaj Finserv, which is a BTST with a stop just below levels of 1705 for targets of 1745.
Okay, all right. Mitesh, thank you very much. So 17,300 is back. It's not going one way. There is a little bit of selling pressure coming through, though. On the RBI front, what's going on? Now, there was a fair bit of debate after the MPC minutes in terms of whether, some are divided about the pace of future hikes and whether we should wait and watch, etc. But Lata is joining us to tell us more in terms of what we should make of it. Lata, over to you.
Well, the overall takeaway is dovish, and one could see that today in the bond markets, and maybe to a small extent that's also helping the Nifty bank. But first things first, the key takeaway that all economist reports that I read this morning indicated is that the MPC minutes show a deep divide, a divide between the external members and the RBI members. The external members are almost uniformly more worried about growth. And, you can see that even more explicitly in Ashima Goyal and Jayant Verma's minutes. But Verma goes to the extent of saying, I want the MPC to stop at 6% repo rate. Remember, at the moment it is at 590, which means he's calling for a pause as early as December itself. And the way in which they're worried about growth indicates that, 35-50 looks unlikely from these kinds of people. Maybe they will root for something like a 25%. But diametrically opposite is are the views coming in from the RBI members, Governor Dr. Patra and Dr. Rajiv Ranjan. All of them are not so worried about growth, and they worry that inflation and instability, financial instability, could be twin problems. Dr. Patra has been more dovish in the past, and he goes on to say that core inflation is actually becoming sticky around 6%, which is the upper limit for the MPC. Their job is to bring inflation to 4%, and it is staying sticky at 6%. He says that's a worry. So now, the economists who have written these reports say that they expect a 35 basis hike even now in December. But Citi's Samiran Chakrabarti points out that the possibility of a 25 basis point rate hike opens up. And both ISEC PD, that primary dealer unit, and Kotak Bank, Upasana, both Abhishek Upadhyay and Upasana Bharadwaj point out that therefore RBI moving to a neutral stance now looks ruled out. They may stick to withdrawal of accommodation, which is their current stance. I just want to add my own point to all this. The external members, you know, the big surprise for me was at the moment after the October 12th reading, which shows that for 9 months in a row, inflation is above the 6% mark, which means the MPC has failed to deliver on its mandate. My sense was that this will bog them down and therefore they will be hawkish because they have not delivered. But surprisingly, that is not at all impacting them. And even when they spoke to us on the channel on Friday after the minutes were published, they just said we will be able to explain to the government why things happened the way they happened. The second thing that was that I feel is possible is now a deeper split vote. You know, even this policy that just went by, it was not a 6-all for a 50 basis hike. It was 5-1 with Ashima voting for 35. It now looks there can be a deeper split in December with probably a 2-4 also. It looks now a little extreme that it may be 3-all for a certain number and the governor has to do a casting vote. It doesn't look like that. But I'm just trying to point out to you that the market is taking home the view that there is no uniform hawkishness, and that will make the future policies a little more dovish. But I mean, we all could be speaking ahead too soon. There is so much of data left. October CPI in India is left, 2 non-farm payroll numbers, 2 CPI numbers in the US, Fed, one more Fed decision. So we could be talking early, but that's the view at the moment, that the most hawkishness of the RBI is behind us.
And the next policy meeting is 5th to 7th of December. Thank you very much, Lata, for highlighting that. So a bit of a dovish surprise there. Let's invite Hemang Jani, the retail equity strategist at Motilal Oswal Financial Services, on the show now. Hemang, afternoon. What have you made of the sharp reaction to Tata Elxsi's numbers? Yes, there was a miss, but the stock is down 8-odd%. And does that put into question the kind of reaction we may see in, say, names like LTT, L&T Technology, which reports numbers, or a KPIT? Because all these are ER&D plays which are trading at high valuations.
Good afternoon, Rima. I think in case of Tata Elxsi, definitely versus the backdrop of some of the other, large cap and mid cap IT companies, the numbers have been quite below expectations. And if you look at the management commentary also, they're not sounding that positive. And there are indications that you might have some more disappointment over the next few quarters. So I think, what we feel is that we should really stay away from some of these names which are focused on certain categories or certain geographies where there is a higher risk, and focus on little more diversified plays like maybe a Infosys or HCL Tech, where there's a better valuation comfort and a better growth outlook also. So I think you might have to really wait for some of the other companies like you mentioned, KPIT, etc. But we think that this could be very company specific and certain domain specific issues.
Okay, all right, Hemang, just hold on to that thought for the time being, though we'll have to slip into a short break. You come back, we'll continue our conversation with Hemang. We'll also cover the final 10 minutes of trade today. Don't go anywhere.
Now, over the weekend, my colleague Anuj Singhal had the chance to speak with Rare Enterprises' Utpal Sheth. They discussed markets, stocks, and most importantly, Anuj also had the chance to understand what made late Rakesh Jhunjhunwala, or as we knew him, the big bull, invest in a stock like Titan. Take a look.
Rare has been synonym with Titan. So what really was one thing about Titan that led to this investment and the fact that you managed to hold on for so long?
And the intangible that we saw in Titan was the culture that Titan had. And that culture was visible not just at the top management team level, that it was, not just in the corporate office, but in the factory workshop. I remember in one of my meetings, there was this 10th grade pass worker who was working on in the factory. And I asked him, what is your annual target? Hoping that he will give me some number which will give me a clue. And he said, I have to generate 30% on the value of this machinery that I'm working on. That was his concept of 30% return on capital employed. When the worker on the shop floor of a company thinks in terms of return on capital employed, that is a culture that we would like to back.
A fascinating conversation over there. We still have our experts with us, Hemang Jani and Mitesh Thakkar. Hemang, everyone was bullish in real estate. The numbers look good month after month, especially in Mumbai as well as the other metro cities. But Oberoi Realty is disappointed, especially on the cash flow side. Your thoughts on real estate, and should one buy the dip that we are seeing?
Yeah, Nima, I think in case of companies like Oberoi, after 3 or 4 quarters, if you exclude one of the projects, there is not much of a growth in the sales per se. But our take is that this overall momentum that we are seeing across, majority of the markets, that is likely to continue. And even if you see the recent data points, be it Mumbai, Bangalore, or even North India, the overall pre-sales numbers have been pretty good. And despite the repo rate hike, there has not been any major impact. So we continue to be positive on names like Lodha and some of the Bangalore-based companies like Prestige and Brigade.
All right, Hemang, we're going to leave it there today. Thank you very much for your time. Just kind of sort of have to start with the wrap out of the market. 3 minutes to go for close. So let's do that. We're going to end above 17,300, just short of 20-25 points short of the high on Friday. And of course, the bigger number is about 17,421 or so, which we didn't get to at all. So banks and financials, really the leading part of the market. Private banks, PSU banks, Bank Nifty. PSU Bank Index, by the way, ends up 3.6%. Names like Canara Bank and all did very well. Bank Nifty is up about 1.6% and the Private Bank Index is up 1.5%. The one sector which was down firmly since the word go was the metal sector, which ends down about 0.75%. Market breadth, by the way, it deteriorated but picked up. But 1,200 lower and 1,000 stocks higher, still in favor of declines in terms of trade. All right, so Nifty stocks and what happened. SBI, top gainer, 3%. Bajaj Finserv, 2%. There was Axis Bank, as I said, financials, 2% higher. ICICI Bank, 1 3/4. Non-financials like NTPC and Bajaj Auto were higher as well. Bajaj, of course, reacting to those results. And then you had IndusInd, which is basically back at 1,200. Reliance was up as well. And I think that was part of the reason why the index was looking good. 2,400 plus on Reliance, about 1.5% in the green. Rima, broader markets.
What a solid day for banks, right? So even mid-cap banks were shining in trade. While the Nifty Bank went home with a cut of close to about 1.5%. You had strong numbers coming in from Bank of Maharashtra, so that fueled a 5.5% rally in that. And remember, even the other two banks which have reported numbers so far, Federal Bank and HDFC Bank, both of them look very promising. City Union Bank, Canara Bank also seeing significant buying today. A couple of the other winners, Just Style on the back of its numbers. BLS was a gainer, stock up close to about 10% by the end of trade after Shankar Sharma bought about 11.5 lakh shares in the stock. IDFC First, Blue Star, a couple of stocks where brokerages have been fairly bullish. You had earnings coming through from names like Orient Hotels on some of the smaller companies like Orient Hotels. The stocks reacting to numbers. On the way down, earnings misses from Tata Elxsi, Oberoi Realty, D-Mart. So these stocks lost in trade, Nigel.
Well, that's right, Rima. Well, just to wind things down, then the Nifty goes home with a gain of close to around 130 points. The SX Nifty had suggested a downtick to kickstart trade. That turned out to be a perfect entry opportunity. The Nifty Bank, solid performance today, closes near that 40,000 odd mark. It's conquered that 20-day MA, conquered that 50-day MA as well, and it's looking rock solid. The mid-cap index, that was a relative underperformer though today, ended marginally in the green, and you had more number of stocks that were declining in comparison to the number of stocks that were advancing. Well, it was a good Monday session then for the bulls, but we've run out of time on this edition of Closing Bell. You don't go anywhere. Money, money, money comes up next.